On the domestic commodities market scene, we're looking at cement. Cement is a major component for the building and construction industry. It is used for foundations, walls, roads, bridges, and sidewalks. For some time now, the price of cement has remained flat. But how sustainable is this? Fumi Adebowale, one of the research analysts with Financial Derivatives Company, will tell us more. Hello, Fumi. Good afternoon.
Good afternoon, Tuesday.
So the construction sector grew by 3.18%. That was in the first quarter of this year. However, the price of cement has remained flat at 2,550 naira per bag. Is this situation sustainable?
Yes, the construction sector was one of the sectors that expanded in Q1. It grew by about 3.18%, and that was due to increased spending in the run-up to the election, as we saw a lot of capital projects during this period. Meanwhile, as the rainy season has started, we've seen the slowdown in the construction activities. However, the price of cement, which is a major component for construction, has remained flat at about 2,550 naira per bag. And this is due to the fact that the cost of production has remained sticky downwards. However, the non-aggressive rivalry in the industry has helped to taper price and keep it stable at that rate. This is expected to continue in the medium term. However, the slowdown in construction activities could weigh on the construction sector performance in Q2 and Q3. But as the rainy season subsides and we approach the dry season, we could see a reversal in this trend, probably in Q4 2019.
Now, cement companies depend heavily on power. The average on-grid power output in 2019 remains below 4,000 megawatts. What has been the impact of this on the performance of cement companies?
Yes, power has been one major constraint faced by industry in Nigeria. However, most of the key players in the cement industry generate their own power and don't solely rely on national output. However, these industry players are still, they are still constrained by a number of factors, part of which is cost of logistics as well as gas constraints. So this has also weighed on the performance of players in the industry. There has been a mixed trend in their profitability as well as revenue.
Granite is a major input in cement production. Although it exists in almost all the states in the country, it is found in larger quantities in Abuja, Cross River, and Ekiti states. Meanwhile, cement is produced mainly in Kogi, Ogun, and Abuja. What has been the impact of this on logistics costs?
Yeah, one of the key in citing a business nearness to raw materials. So granite is one of the major inputs in producing cement, which is made, and it is mainly found in Abuja and other states, while cement is produced in Ogun and Kogi. So given the distance between where the raw materials are found and where they are being used for production, it has increased logistics costs, and this accounts for, I think, the most of the operating cost of most of these firms, and this is also affecting prices. It has been affecting prices, but the non-aggressive rivalry has helped to taper price at the current level.
What is the outlook for cement prices as we approach the dry season?
Yes, in West, prices remain stable, but the slowdown due to the rainy season could affect the construction sector performance. But as the dry season approach, we will see increased construction activity, so that will increase demand for cement, which is a major input, and that could reverse the trend. That could increase the performance of the construction sector in Q4.
All right, thank you for your time, Fumi Adebowale. An Anglo-American Platinum expects its half-year earnings to rise by at least 80%, helped by an increased metals price and one-off impairments that weighed on results in the same period a year earlier. Amplats said headline earnings for the 6 months ending June 30 were expected to be 2.69 billion rand more than the 3.363 billion rand earnings reported in the same period a year ago. Amplats is expected to report its half-year results in July 22. Zimbabwe has brought back its own currency, the Zimbabwe dollar, just over a decade after its usefulness was destroyed by hyperinflation. Effective immediately, currencies including the US dollar and the South African rand in use since 2009 will no longer be accepted as legal tender. A local quasi-currency known as bond notes, which was introduced in 2016 but can't trade outside the country, and their electronic equivalent, the RTG's dollar, will now be known as the Zimbabwe dollar. The authorities had abandoned the Zimbabwe dollar after inflation reached an estimated 500 billion% in 2008. The central bank also announced a series of other measures, including raising the rate on its overnight window to 50% from 15% to buttress the currency. Egypt aims to conclude a non-financial agreement with the International Monetary Fund by October to replace a 3-year loan deal that expires this month, a step that may help the country remain an attractive market for foreign investors. The Finance Minister, Mohamed Maiti, who is attending the Bloomberg Emerging and Frontier Forum in London, said officials are exploring the various IMF programs Egypt is eligible for. When Egypt signed its $12 billion accord with the IMF in 2016, it was suffering from a crippling dollar shortage since then. It's attracted billions of dollars into its debt markets. A new deal, even if it doesn't come with loans attached, may help reassure investors that economic policy will stay on the current course. And the bear's diamond sales have plunged again, underlining a slump in demand from the miners' customers who are struggling to make a profit at current prices. Sales by the Anglo-American PLC unit plunged 33% from a year ago to just $390 million and were down 6% from an offering last month. While this is often a quieter time of the year following the key holiday period, total sales for 2019 are still much weaker than in previous years. Diamond miners are facing a mini crisis as demand remains weak, while supply, especially for smaller and cheaper stones, is abundant. Jumia Food, a unit of New York-listed e-commerce platform Jumia Technologies, is offering cheaper menu options in its African home market to attract lower-income earners as it seeks to boost growth. The platform, which delivers food and drink in 11 African countries, joins other international companies such as ride-hailing firm Uber and China's Huawei Technologies, who are looking to grow their customer base on the continent beyond the middle class.
Jumia became Africa's first unicorn, a private company with a $1 billion plus valuation, to test the public markets for a sub-Saharan tech firm when it listed in New York in April. When it launched in 2012, Jumia Food focused on the middle class who could afford internet access, but growing smartphone use and plummeting data costs are opening up the market to lower income earners.
We're also looking now to target this mass market customer that is really starting to come online over the last couple of years, for the first time realizing that a level of radical convenience and assortment is not just the preserve of you know, the upper classes. It's now available to the mass market because the level of sophistication of technology, the level of experience that we now bring to on-demand means that we can hit a price point that's attractive to them.
The platform's 2019 strategy includes working with restaurants to offer relatively cheaper meals of a maximum of 300 Kenyan shillings.
And that's it on the program. Thank you for watching. I'm Chimeze Obi Iwago.